even as economic fears grow. We're talking about the best picks abroad, companies in Japan, France, and Ireland, all reflecting good balance sheets and solid market positions. And here to talk more about investing strategically worldwide, we've got Abhay Deshpande, who is the Centerstone Investors Chief Investment Officer. Great to have you here with us on set today.
Thanks for having me.
Absolutely. All right, so let's talk about some of these opportunities internationally. What is the first thing that an investor should be looking for in a company when they're evaluating their balance sheet, looking at the market that they operate in, and trying to determine an investable opportunity?
Well, at Centerstone, we're value investors. So the first priority for us is to make sure that there's a margin of safety in any company's stock that we're looking at. And part of evaluating that margin of safety is understanding what the balance sheet risks are, especially these days where you have, more and more reports of debt, problems with liabilities on the bank balance sheets and what have you. These risks also exist in, operating companies. So we're looking at businesses, the balance sheets. When are their debts due? Do they have massive maturities due in one time period, or have they turned them out over time? So that's on the balance sheet side. On the management side of things, we want to make sure that the management teams, by and large, understand that they're operating on the behalf of shareholders. The management teams understand that allocation decisions with capital, excess cash flow, are reinvested or distributed to shareholders as appropriate, and not invested in vanity projects or in pointless M&A just to satisfy some ego of a management team. And then finally, the business, we're looking for businesses that are generally speaking stable in terms of market shares or returns. Things that, I can literally, Buffett used to say this years ago, can I go to sleep and the business is just fine for the next 10 years, not have to worry about it, right? That's your ideal situation. And when you have a margin of safety, meaning that the price is well below what a reasonable buyer would pay for the entire business, its intrinsic value, so to speak, then that's where the magic happens.
Is it easier to find examples of those kinds of companies abroad right now than in the United States?
From a qualitative perspective, just like when I mentioned the balance sheet, the franchise the duration of the franchise, the business quality, and also the management quality, it's easy to find those things overseas as it is in the United States. The main difference is the margin of safety, or the prices that we're paying overseas, are much, much lower than they are in the United States. You've had a 10-year period. Maybe the last year is a little bit counter trend, but for about 10 years, the U.S. market had continued to elevate in terms of price-earnings ratios, or just valuations, generally speaking. And due to a succession of issues overseas, the financial crisis, of course, in 2008, the European debt financial crisis beginning in 2011, the Chinese sort of deindustrialization to some degree since 2017, it's meant that a sequence of events have occurred to kind of knock the international markets on their back, just as they would recover from each of these challenges. It means that the stock markets, for the most part overseas, have just basically flatlined. They've gone sideways for 10 years. And so you've had this huge gap develop between valuations. So yes, you can find them anywhere, but the prices just are much more interesting overseas.
And so when we think about the areas internationally that even the IMF has forecasted will account for the majority of global GDP growth this year, talking about China, talking about India, how are you looking at companies that are within those regions saying that they could benefit, or at least thinking that they might be able to benefit from being the lion's share gainers over the course of this year?
Sure. In some of those emerging markets, the further away you get from kind of the Western concept of capital markets, the more you end up taking on political risk, corporate governance risk, accounting risk, things like that. And you can then, do the work and figure all that out and buy some good companies in those countries. Or you can go to Europe or even companies in the United States that have exposure to those countries, and you get the growth through the exposure of those developed market companies in those countries without the baggage of corporate governance or it's like political risks and even sometimes currency risks. So our favorite approach is to go to Europe, for instance, Japan, the U.S. of course, to get that exposure. the growth exposure in these emerging markets.
All right, so let's get specific, and we're listing some of your picks there. I want to start with the one of them that I hadn't heard of, maybe because I'm not a cyclist, and that is Shimano, if I'm saying it correctly, which is a Japanese bicycle company.
Yeah, surprisingly, not a well-known company unless, as you mentioned, unless you're a biker or a cyclist.
Or a fisher. Yeah.
Or a fisher, yes, exactly. Yes. Rod and reels, they're huge in rods and reels. And Shimano, essentially they make bike parts. So these are derailleurs, braking systems and whatnot. On a bicycle, the most expensive part of that bike is really the bike parts, with some exceptions when you get into high spec frames and whatnot for racing.
Sorry to interrupt. Are you a cyclist? Are you somebody who bicycles, and that's how you know about the company?
I mean, I don't eat at McDonald's, but I own the stock.
Right. No, I was just curious because I think of Buffett as somebody who sort of has an emotional feeling about particular companies or particular products potentially.
Sure. I mean, I'm flattered that you'd put Buffett in the same sentence as Centerstone, but despite that not being the case, the common element with a Buffett approach and Shimano is that they dominate the market. There's only one real competitor, and it's really a roll-up competitor called SRAM. The business is growing. It is, quote unquote, cyclical, but it is generally a growth business. Younger people are getting more and more into cycling. And so it has all the elements of a good franchise, a good stable business. Management team has been over the years very good with buying back stock and distributing cash flow to shareholders through dividends. And the balance sheet is solid. So I mean, you have all of the elements of a franchise, a Buffett-like company, but the stock is down significantly from its peak, had a huge COVID bump, and then it's reversed most of that, and it's trading for 15 times earnings.
One of the other picks that you had, Ryanair, of course, as we think about the broader air travel demand situation right now, why Ryanair?
So Ryanair is the only airline I've ever owned in my entire life, and I've been doing this for 30 years. And it's because most of these airline businesses, they tend to lease the airplanes. They don't really have assets. They have a massive amount of financial and operating leverage because of the debt that they have, and also because of the operating leases they have on the airplanes. Ryanair is very different.
Doesn't it make more sense to lease the airplanes, though? Because if you're churning through an airplane because of the amount of routes and capacity that you have to fly, if you're seeing increased demand for the balance sheet, doesn't it make more sense to lease them?
So from a short-term perspective, yes, but on a long-term cycle perspective, because of course there's ups and downs in that industry. Yeah. When demand goes down, passenger traffic goes down, if you lease the airplane can get mothballed and you're still paying the lease payment. If you own the airplane, you can mothball the airplane. You're sort of paying through kind of just deferred maintenance and whatnot, but you're not having to pay the cost of ownership of that airplane. So it is able to manage, when you own it, it's more expensive to build an airline business this way, but when you own the asset, you can manage your cycles much more appropriately. And you've seen that with these guys. They own the assets. They have the lowest, another asset they have is the slots at these low, kind of like these airports that are not, city center.
Sure.
And so they can, between the two, offer the lowest price, and it's a structural advantage. In other words, no one else is coming in there to replicate that. They can't. It'd be too expensive to replicate that management or that competitive position. So again, this is a different industry than Shimano, right? And you do have these ups and downs.
Sure.
But as far as the franchise goes and stability and durability of that business, it has it. It has a good balance sheet. Management team's good. Actually, management team has been excellent in deploying capital to further shareholder interests. And the stock has done essentially nothing because of all the reasons you'd expect.
Yeah. Well, I mean, you had some other picks, but we'll have to have you back to talk about those because we're almost out of time. Thank you so much for being here. Abhay Deshpande is Centerstone Investors Chief Investment Officer. Thank you.